Welcome everybody to Charts and Chats with Gordon Scott CMT. That's me. If you're here, I'm glad about that. We're going to have a look at the one stock that went up strongly on Friday and why it's still, especially now, a good buy. That is SWBI. And we're going to look at a lot of stocks, which are really good candidates for the downside. But do I think this market's going to crash? No, I don't. In fact, I think there's some really great buying opportunities coming up. And let's get right into it and show you how to find these trades yourselves and how these trades have about a 65% chance of being profitable over the next 20 days. That's what the research shows. I will get into showing you how I find these, how you can find them very quickly, free websites, and why they have that kind of track record, and also the best way to trade them. So we're going to jump right into that right now. Give me a chance to share my screen and we'll get going. And we'll do that screen and go with the charts. Okay, so first off, the thing you need to know, if you are paying attention to the US markets, there was quite the downward move well, let me go ahead and bring that up here. I'm going to bring up, let's see, this chart right here. That is kind of in my background already. And add that to the stack. There we go. All right, so let's go look at the S&P 500. And you see that big drop like that, right? All these lines here I got going on. That's going to be really interesting to you. I'll show you that in a minute, but maybe a little cleaner chart look would be useful right now. So let's look at S&P 500. There it is. See that big old drop? We gap down. We hit opening price and then we drop and close close to the low. See that? That is a very bearish sign. I'm really surprised that the S&P 500 came off like that. The surprise is not that it dropped. That's, I was expecting this kind of a drop a month ago, and we actually kind of got a little bit of something like that in May. Now this one here, some people might say this is really bad news. This is going to drop. This is an exhaustion gap, by the way. That's probably, you can look that up on Investopedia or wherever else you want to check that out from, or you can check out the CMT curriculum, which I helped write for years. The exhaustion gap is a pretty strong sign of a top. We've got a double top there on S&P 500, and then we've got an exhaustion gap off the second one on high volume. But notice, see, it's a dividend day. That's a big dividend. And that's part of what's going on there. That drop is factoring in the dividend price. Now, the Qs, they dropped from their high, but look at the formation look how different the QQQ is compared to SPY, right? Well, the QQQ doesn't have dividends. So that's going to be a big part of it. But if this were the same, if this were a really bearish signal, see back here, QQQ had an exhaustion gap. And what happened? It went down, but came right back up, right? This thing dropped, and see how it dropped, but came up that day. It wasn't this day straight out of the gate. If both of these had done that, same kind of formation right out of the gate, then we could have seen some exceptional downward move, which is kind of what I was expecting. The conditions were right for that. Well, the conditions are still right for that. We could see big moves down, but I don't think we will. I think we will probably see some selling in general, but it'll probably just make the markets kind of go back and forth for the next week or two before earnings season. But given the two, I would prefer to choose an upward move. QQQ is the NASDAQ 100, right? Well, look what it's doing. It's come down in the middle. Now, this is what's known as a Harami formation, and Haramis are notoriously weak predictors. in terms of the percentages of time that they actually call it right. Um, but is that the only reason why I think that stocks aren't going to crash? Well, no, there's a couple others. We'll get into it. So Helen, chat from Helen. Hello, oil surprise and Aussie yen is slow. So Helen's been watching for several weeks. Thanks a lot for those reminders, Helen. That's right. The Aussie yen, if you're new to this, the Aussie yen is something that I like to track. The Aussie yen pair and to compare it with the Nasdaq 100. So let's bring that up here. AUD JPY. And because the Aussie yen all by itself is 75% correlated with Nasdaq, um, but is a good proxy for global investors' attitudes towards taking risk or not taking risk, sort of risk on, risk off trade. Now, look what happened last week, right? Huge drops. Now, that was Friday. Here's today. Here's what's happening. It's bouncing up off of this huge drop. So, could it be that we're in for more downward draft as far as Aussie yen is concerned? Very possible, but I would want to see it break that line right there, 82, call it 30, 82.33. I'd want to see it close below that before I would say that's an indication. Because look what it did. It came right down, same low, bounced on it. Good chance it's going to work its way back up to that high, if in fact the Nasdaq maintains this level. And where are we right now in terms of the Nasdaq futures, right? And the Aussie yen in a minute by minute chart. Let's have a look real quick there. Here's the Nasdaq futures, how the U.S. markets are shaping up. And this is the daily chart. You can see that little green is showing us that it's kind of bouncing. But here, let's get into the 15-minute chart. Okay, so now this is right there. That's the ending of Friday. This is Sunday, and then what's been happening just since Monday morning, midnight GMT, and so forth. So the Nasdaq has jumped up. It's pulling back here as we approach the open. So maybe this means that we are going to see some new selling. I don't know. But the Aussie yen, on the other hand, let's get a 15-minute look of that. And see, that has gone down to, yeah. So this is kind of the same time frame, both these charts right here. And see, that volume's pretty good, pretty steady. It dropped, but it has come all the way back up and holding. Okay. So Aussie yen is not just giving it up, whereas the Nasdaq is kind of trending down here for a little bit. So either this is going to catch up and start following the Nasdaq, or the Nasdaq's going to turn around and come back up. Because the sell-off was kind of hard, I'm just sort of expecting that the Nasdaq is going to find some support and bounce, come back. But the way we will know that that's not going to happen is if between now and the time we're done with this session this morning, is if we see the Aussie yen sort of pull down and go with it over these next 4 bars, and this continues dropping, then we would know selling is probably on the way for today. All right, so that's a quick look at just the intra minute for now. Now let's go back to what I was talking about at the beginning. How what are you going to trade in this environment? If you're looking for a stock to buy that you think is going to have a good chance of being higher, say a month from now or more, but I use 1 month as kind of the marker. Well, this is the stock that I would tell you has a 65% chance of accomplishing that. Why? Well, see this gap and then a tall range that follows it. Okay, now these lines right here, what all this is Keltner channels stacked on top of each other. The first one is 1 ATR Keltner channel, the second one is 2, the third one is 3, and the outside one is 4. 4 on an exponential moving average on a 10-day time frame, whereas all the others are on a 20-day time frame. Okay, that's fine. Those are not Bollinger Bands, they're Keltner. What are Keltner channels? They're just bands that are based on the average true range movement of the stock. I like them better than Bollinger Bands because they don't have the sort of, I mean, Bollinger Bands, when you get a jump like this, the top band goes way up and the bottom band goes impossibly way down. It's like, what's it doing down there? That's because it's using the standard deviation of data. It's not using the actual price movement. Keltner channels use the Keltner bands, channels, Keltner channels use the actual price movement, and so they tend to be a little less, springy, bouncy, stretchy, whatever you want to call them. And so they make for a better marker of levels. That's what we're looking at. And why is it important that I care about? Because they jump way up here. Well, I got to tell you, in a few weeks, actually, what is it? 2 weeks, the 4th of July, I'm going to be teaching a class about how to become a better trader. And that class, some of you who are here right now have been to that class. And if you want to chat in your comments about whether or not you thought that class was worthwhile, I would love to hear about your response and whether or not you thought it was any good. But that class is a synopsis of the last 20 years of my work coaching individuals on how to become better traders. In fact, I found things that increase your probability of success by 10 times. Your probability of success at being a trader, a successful trader. And that's based on, there's a study done on day traders. They looked at like 10,000 different people who traded, um, who were day traders and stock day traders. And they found that the majority of them wiped out, in a little more than 2 months, between 2 and 4 months. However, they found that people that could hang around for a year had a 10 times better chance of becoming profitable, successful traders over the course of their trading career or lifetimes, depending on, professional or non-professional. Right? Well, how do you make it to that first year as a trader? That those are some of the things that I would include in this class. It's real simple. You have to know what kind of trader, personality wise, you are and how to get the kinds of results that fit with your personality in the markets. And that's very simple. That's something we cover in the first hour. In the second hour, we cover how to go out and find good stocks. And that is what I'm going to give you just a short synopsis of today. So there's research, which I don't have time to get into explaining all the details of what the research uncovered. But the research was published in the Journal of Technical Analysis back in 2013. And it was a fantastic paper and it's still relevant today. And it basically was a study of gaps and probably the best study that I have ever seen on just gaps. Do they matter? And what can you do with them? And the study uncovered the fact that all by itself, blindly a gap is not particularly predictive, but a certain kind of gap can be very predictive. And so that's what I've done is I've encapsulated all that research into a simple uh, style, and I created a screener, and I'm going to share that screener with you today. Um, to show how you find these stocks. All right. So, well, in fact, let me just jump right to that right now. I went to this website, Finviz, created a free account, and I use Finviz as an example because it's kind of easy, quick to get to, and it is a free website, so you can duplicate what I'm showing you without having to spend another penny. Um, and what we have here is the gap filter that I do. Okay, I'm going to, for those who are watching this live in a Zoom presentation, I'm going to share that in the chat window. And so then you can just cut and paste that screen. Just actually click on the link. I sent that to the panelists. Sorry, let me send that to panelists and attendees. Try again. All right, there we go. So all you have to do is click on that link and it'll bring you this screen. For those of you who are watching on any other platform besides Zoom right now, then you'll want to like screen capture what you see right now. and then go to Finviz and duplicate it. Okay. But warning, word of a fair warning. Finviz, I signed up for a free account and I did not use my regular email. Don't do that. Right. Finviz is probably one of the most notorious honeypots I've ever seen, but it's a bit of evidence for how good the site is if you can kind of get past that. So I use AdBlock Plus on my browser. Finviz is just merciless with these pop-up ads, and the email that I use is my spam trap email, and I literally get 1,000 emails a week, and I never send anything from it. It's just all the stuff over the past several years of using sites like this that spell out your email. So don't give your regular email to this site. Actually, I don't know that they sell out. It's just that there's so much stuff that comes, that themes like I didn't sign up for this. So great data, but they don't charge anything. How do they make their money? They got to make their money somehow. They probably make their money by selling your list. So FYI. And you might feel like, oh, well, I don't want to go to a site like that. Just, hey, hang on, I've got a better site that doesn't do that kind of stuff and has even better data. But this one is the most simple, and I want to show you why SWBI. Well, I ran this scan on Friday, and SWBI was the only stock that came up. So SWBI, what is it? It's Smith and Wesson Brands Incorporated. Smith and Wesson are, yeah, weapon makers, gun shooters, rifles, and the like. And kind of funny. Well, it had earnings, and the earnings were unexpectedly good. Mai says she'll send it out the link on social media. Awesome, thank you, Mai. So if you're on social media, if you look around somewhere in your feeds, you'll be able to see that a link was sent. If you're listening to this on a recording, again, everything I said before applies. So SWBI came out, and I'll show you my other favorite site here for doing stock screeners, and that's this one. It's Market Chameleon. But I'm going to come back to you and show you how to do a screener, because it didn't turn up SWBI. It turned up some other stocks that are really interesting. But SWBI was the most interesting. I actually went and initiated trade on this myself before the close on Friday. It was like halfway through the day when I saw this, and I jumped on it, and it went up more before the end of the day. It doesn't always. It's a very risky thing to do. The methodology that I have developed around these gap trades is that you wait until the next day's opening price to put on the trade. Why? Well, because there is a 58% chance that wherever it closes, the next 5 days, somewhere over the next week, is going to deliver a lower price than that. So an excellent strategy is if you see this, right? It's like that stock that's moved too far. It can't go anywhere. No. Actually, it's a fantastic signal. I mean, it's not guaranteed that it's going to go up, but it has a much higher than average chance, and it will beat the S&P 500. If it goes up, it will beat the S&P 500. One, because it's an individual stock, and two, because statistically, that's what my research shows, is that and the research from the Journal of Technical Analysis, between the two of these, their research and my own research, I convinced myself, hey, this works. This is a persistent, valuable strategy. And so what I do with it is I wait until the signal has happened, and then basically try to bargain shop, buy the dip on the next 5 days that will come after. Now, there will be some trades that just take off and go from here, and those are the best. And so if you don't want to miss those, then the thing to do is buy the open, whatever it is, which would be today, right? For Smith and Wesson, SWBI. So that's the methodology. Does that mean that thing is guaranteed? No. You got to put a stop loss at least below the opening of that tall candle. So in the case of Smith and Wesson, that's a very big stop loss. It's going to be, see, this thing doesn't really move all that much. So to make this huge move right after earnings, and then you're going to give it the stop loss all the way down there. Yes, yes, that's what you're going to do. Because sometimes you get these blow off sales and they come down hard. And hey, not every trade, it's not 100%. Nothing's 100% in technical analysis, but in this case, it's pretty good. What's going to happen is you're going to try to take profits anywhere over the next month that whatever distance. So let's say you have 23.34, and then your stop loss is, well, let's just keep the math real easy, 20.34. So $3 stop loss, right? Then that means you're just going to take profit at $1.50 higher. If within the month it hits $1.50, take the profit, move on, and get the next trade. This is a very productive strategy that I've used for years, and it works very nice. Uh, it has a good chance of outperforming the market in general if on occasion you let those trades run. We're not in an environment where it's a great idea to let the trades run. Um, because I don't think that the market is going to strongly trend higher. I think we're going to have all through the summer, we're going to have a lot of up and down, a lot of sort of crosswinds back and forth. So you need to kind of capture whatever quick gains you can all through the summer. Just grab the fluctuation. Here's one I believe that will fluctuate higher over the next month. So you either grab the $1.50 in less than a month, or you wait till a whole month, and wherever it is, if it's up, then you can put a stop loss and let it run, or just take the profits, right? That's the construction of that trade. That's how you would, that's the best way to trade that trade. Now, some people feel like, no, that's not my style. I don't want to just buy and sell quickly. I want to buy and hold and let it really run for quite a ways. That's okay. But there are different methods for that. There are different kinds of trades that you want to make. And I believe, um, yeah, not running trades all season. Yeah. So Helen, you attended that class, didn't you? Yeah, Helen just chatted in again. Didn't you attend the class last January that we did? If you feel like that was a worthwhile class, I'd love to have you share your comments. Actually, either way, share the comment. But this class that's coming up in 2 weeks is uh, it's the kind of thing that I have taught in other venues, or certainly parts of it and pieces of it, and and the people that have been putting it on have charged thousands of dollars. I'm really excited about working with Actions to Wealth, because these guys, they're not going to charge that much money. I can't remember what it's 497, or is it, or are they putting out a discount? Um, I can't remember what the number is, but it's a lot cheaper than I've ever been able to produce it for anybody else to access. So I'm really excited about that, and hopefully that means a lot of people will get a chance to come and hear it. Um, let's see. Was that the one? What type of trader are you? Quiz one. Yeah, the 2 question quiz. That's the class that I taught. That's right. Yeah, the very first one, the very first class I did. That's correct. So, Helen, I'm sorry, I'm responding to Helen's chats there. Oh, she says, thank you, Helen. Yeah, that was amazing. Okay. Quote, direct quote from Helen. What can I say? I mean, I took 2 years ago, right before the pandemic, I took 15 people through the program, the specific instructions that I'm going to consolidate into one day. I took them through an 8-week course of the information that is in that. It was one-on-one coaching. And over the years, like I said, I've been doing this for 20 years. And usually when you coach with people, there's a less than 50% chance that they are going to actually have success during the period of time that you coach them. And they have to really work at it. You know, they got to spend a year or more, maybe 3 years. Let's see. She says it's the best class to figure out what kind of trader you are. I'm still reeling from how you use just two questions to tell folks what kind of trader. Yes, yes, thank you. Okay, I'm blushing. So what she's talking about is in the class, I have a two-question quiz. So I've done this. I started with 20 questions, I got down to 10, then I got down to 8. Now I've got it just to two. Pretty cool. In just two questions, we can divide you into a spectrum of 5 different personality traders. And when we did this in the class in January, there were only 2 people in the whole class that felt that what we were doing didn't match their personality, and those 2 people were actually confused about what the questions said. So if you were able to uh, read through the questions properly, or if you're able to understand in the which we do in the class, we kind of articulate what those mean. Then it divides you up into one of 5, and each one of these 5 really fits. Okay, so what I did is I took these 15 people through the coaching program that starts with that quiz. What kind of trader are you? And what I found was that all of them, all of them felt like they improved in their knowledge, all 15 of them. But within 8 weeks, more than half of them showed progress, showed better profits in their trading than they had ever experienced before. They were profitable right then. So I felt like that was a huge success in terms of a coaching program, because of all the coaching programs I've ever worked with or written. I've written dozens. I've never had one that showed those kinds of results, that high level of quick, profitable behavior right out of the gate with and these students ranged, from, hey, I'm just getting started. I got my $30,000 nest egg. I'm going to take this, right, to somebody who had been trading for 10 years, had nearly 1 million in nest egg, but they were just struggling to ever get profit year after year. Kind of a hobby for them, but they within the first few weeks, they were trading profitably and for the first time ever. So, I'm really laying it on thick, but I got to tell you, I am not ashamed of explaining that to you, because I'm pretty proud of it. I'm pretty proud of the fact that I came up with that coach thing. So anyway, this class will have one day of all that information encapsulated, and and for the price it's coming, I just feel like I don't know how to help people any better than that. One more comment from Helen. Most amazing was that it was accurate for me. Took some stress off because I understood why I was doing what I was doing with trades. Exactly what we're supposed to do. Exactly what I want to have happen is de-stress your trading and make it more consistent with what you personally would naturally want to do. See, when my kids were young, I used to coach their soccer teams, and I found, little kids, 8, 9, 10, 11, 12, those sort of ages. I mean, they're not super schooled, some of them, but that's not who I was coaching. Just directly coaching. I found that I didn't have enough time to actually teach them anything more than here's what a throw in is, here's what a goal kick is, et cetera, et cetera. And so if I actually wanted to win games, which as a coach, you always want to win, right? And kids have more fun when they're winning. So what I found was that if I look at the kid and I say, what do you naturally want to do? You're somebody who just likes to kick the ball hard. You know what? You're going to play sweeper. You're going to play defense. You're going to play whatever, right? I like to be somebody who just dribbles along and just tries to outfox somebody else, tries to play keep away with, you're my midfielders, great, and then I love to just try to score a goal anytime I get a chance, even if it's a horrible shot. You are the striker, right? So just you put them where their personality naturally goes, and then when they get out there and do what you want, you just compliment them. I had tremendous success coaching with that method. I could go on and tell bragging stories, but I learned from that. This is about 10 years ago. I learned from that gosh, there's something that I need to do to help people who trade have this similar experience, right? You need the quick feedback, not from me, but from your trading. that trading needs to give you the feedback to say, do more of this. How can anybody recognize that? See, my background, I have a master's degree in instructional technology. And one of the things I learned way back when that still stuck with me in my master's degree studies and in the thesis that I did for that was that 80% of the time when there is a performance gap in corporate work America, right? 80% of the time, um, the problem is not about instruction. In other words, most companies are like, oh, we have these people, they're not performing up to expectations. Well, let's train them. Let's give them training, and then they'll be better performers, right? What people in my profession recognize is, hey, it's not training they need, it's feedback. They need a way of being able to see, right? So that's what I ended up developing this whole thing out of, is a way to get feedback for yourself as you're trading. So now let me walk you through these trades, how to find them, and then how to get feedback on whether or not it is actually working for you. And so you can know to do more. All right, so here's the first one. I told you here, what we want to do is look at this stock, and we want to try to buy. I'm going to try and just make a little rectangle there. We want to kind of try to buy somewhere here the next 5 days in this range, about halfway up the candle, or higher, right there. That's that's the target. Okay, and I made that a red box. I'm going to change that to a green, so you know that's buying. You want to be a buyer in this range, right? So if I were to watch the stock and it takes off and just goes up and up, and I'm going to say, okay, Celebi, the only way to get that is if you buy the opening price. But it depends. You see, are you the kind of person who likes to shop around? If you decide you wanted to buy, I don't know, maybe a car, maybe a big screen TV, maybe something that's kind of a big ticket, an appliance, a big ticket item. Are you the kind of the person that just like, oh, I can't stand it, I just need this, I'm going to just go buy, I'm going to do a quick amount of research, just see what the best reviews are on Amazon, and then go buy that thing? I like to buy it, by going to a store, or do you like to buy it online? Which, whatever. The big thing is, how quickly do you arrive at the decision? There's like, I'm going to go, I'm going to buy, I'm going to get it. If I don't like it, I'll deal with the consequences. Or it's like, no, I got to do a lot of study here. I got to really look into it. I'm going to spend a week, maybe two, looking over my options. Or you're a super researcher, right? I'm going to spend 3 months to make sure that I get it. And not only am I going to spend 3 months researching, I'm going to wait until I see the low price come in, and then I'm going to jump once I know what a good price looks like, right? See, where are you on that spectrum? Well, if you're the intense researcher, bargain shopper, don't even bother buying that first opening, because you're going to be disappointed at whatever the results are. You're going to buy it, it's going to fluctuate, it's going to come down. You're going to, oh, this is stupid, I'm out of here. Just wait, bargain shop, buy that dip. If you don't get it, it's not your trade. Move on, right? So you trade according to your personality. And then what you do, as we mentioned before, you set the stop here, and then whatever the distance is, somewhere in there, you set the stop, and whatever the distance is, then half that distance, you will take that um, up. So basically, you're going to risk two to make one. All by itself, that's going to set up a 66% win rate. Now, as I said, this thing statistically has a 65% chance of going up over the next 20 days. So if you set the trade up this way, your win rate's probably going to be closer to 70% over many trades of this style. So winning a trade 70% of the time on something that just has random movement, which is what most stocks have, then that's pretty good. That's a very high probability setup, and it is. I mean, I've made this trade literally hundreds of times, and the statistics bear out. So I don't have any problem trying to suggest to you that that's the best way to do it. But that also comes a little bit from my own personality. I like the positive reinforcement. Am I winning 2 out of 3 trades at a time? If so, then I know I'm doing it right. Now, there's another way you could do this, right? You could take the tight stop loss halfway down the candle and then just put just a little lower than halfway, right? And you can buy anywhere in there. And whatever distance you buy, let's say you manage to get it right here at 22.80. We got the stop loss at 22, so that's 80 cents. Well, $1.60 higher from 22.80 is going to be 23.40, right? No, 24.40. Yeah, 440, right about there. Okay. So then if you do it this way, you see, then you're risking one to make two. Now, all by itself, that situation will give you a trade where you're going to win only 33% of the time. But when you win, you're going to get twice as big a win. And you're like, "Gordon, that's stupid. You just move the exits around and that determines your win percentage." Yes. Yes, it is literally that simple. And if you don't believe me, go back test it for yourself. I did. I did back test it 10 years ago, multiple times, multiple ways, and I was stunned to find out it really is that simple. All right, anyway, let's move on. We're just going to talk about the fact that you can trade risk two to make one or risk one to make two. But either way, if you follow this gap strategy, if you make trades that enter on this gap strategy, you're going to get about a 3 to 5% benefit, a 3 to 5% edge over and above random statistics, and that's what you're looking for is that kind of an edge. Okay, so there are also trades you can make from this sort of gap strategy. Oh, I got to quickly come back here. Sorry. How does the gap strategy work? Well, it looks for something that has gapped. You got to see, clear space between the low and the high, right? Full on gap. But it really is nice if you go from wherever the price closed to wherever the price opened, the 10 period moving average crosses in between. I don't have that on here, but I can put that on real quick and you'll see it for yourself. That's actually the 9 period moving average. By default, that's what it puts on. Okay, let me just change that so that you can see exactly what that moving average looks. So now the moving average was right here, and where that where that closed the day before, where it closed the next day, crossed over that line. That's the 10 period moving average. Okay, so when it does that, it increases. That's an edge all by itself. There are three factors that the Journal of Technical Analysis research uncovered that actually give you edge. The crossing of the 10 period moving average is one of them. And the other one is if it closes higher than it opens. And the third one is if it closes closer to the high in a significant way. It's got to be kind of a big candle. The level is 1.4 times the average ATR. I find that if you search for anywhere from 2 to 3% move to the upside, it comes out to about that same size that has the edge. So those are the three factors. Does it close? Is it a green candle? Did it cross the 10 period moving average? And did it move up more than 2 to 3%? Those three, if you have them together, then you get a better than 60% chance. So 10% above average, right? That it's going to beat the S&P over the next 20 days. So I believe that we're in a bullish situation, a bullish move market. Why? Well, because of this. I published a book with a co-author, Tony Turner, in 2013, and we published this research that if, in fact, you have the S&P 500 outperforming the utility sector (XLU), and you have declining average true range over the course of a month, then the stocks are more likely to continue trending higher. And you look at this indicator, it's showing us exactly that. Now, back in February and March, it looked like maybe the S&P was going to start getting more volatile, and the utilities were going to outperform it. But it has to do that 2 consecutive months in a row. If it does, there's a very high probability that a bear market proceeds or follows afterwards, because that signal precedes a bear market about 9 out of 10 times. Well, it didn't actually materialize. The signal did not materialize. And so that means that the market isn't really fully ready to start collapsing and going bear market style. Not yet, not even yet. So that's why that's another big reason why I feel like, yeah, we're seeing SPY make this exhaustion gap. We're seeing the QQ cube drop, but yeah, I think it's going to come down, find some support, and head back up, make new highs. So that's why you want to be a buyer. However, that being said, there are some stocks that are really weak right now, and that's because of the inflation trade sort of coming off, right? Um, oh yeah. So Helen asks, so if you have those three conditions, then where do you enter? The open of the next day. After they're all done, after you got the whole gap thing going up, you enter the open of the next day, or you bargain shop for something in the upper half of the candle over the course of the next week. Either one are valid entry points. Okay. Great follow-up question. So, so I think that S&P 500 has got some room to go and go up and make a new high. And so I want to be a buyer. How do I find new stocks on a daily basis for that? Well, I showed you what it looks like on Finviz. Price is crossing the 20 period moving average. They don't have a 10, otherwise I would have done that. I like stocks over $20 a share. I mean, you could use anything else, but for what we're doing here, you want stuff that's not low price stock. I have a whole different system for that. Great system too, but that's not this. Average volume over 750K. You know, you can mess with that, but I don't recommend it. Optional and shortable, that's really doesn't matter too much. Stocks only, no ETFs in the search. And then the gap, it's up 2%, and the change from open is up. So you can see this screen gets all of those characteristics that came from the Journal of Technical Analysis research. The other website that I really like, Market Chameleon, it's got fantastic data, especially if you're an option trader. And the free course is, or sorry, the free um, uh, you can sign up for free. You don't have to pay anything. And the free access sign up is really worthwhile, and it is not the honeypot kind of thing. It's they'll send you email if you want to sign up for their newsletters and stuff, which is actually pretty good because they send you these automated alerts. But they don't. I mean, I have not had the experience where they spam you a bunch, and the pop up ads are not bothersome. So this is a really nice place. I actually have the full premium access too, but what I'm going to show you isn't really part of the premium access. You'll be able to find this for free if you just sign up for the free account. So I created my own preset of all range trend change. And so what do I do? Well, I'm searching for a price change of 3% or above. I just want the price to be above $10 a share on these two. That's the only thing I'm doing there. Now, so you could go 2%, but then you would get a lot more candidates, right? And then the average daily stats I'm looking for over the last 15 days, I want to see 60% of the trades being positive, but the last 30 days below 50%. So think about what that means. It's like I want to see more red candles in the last 30 days, but within the last 15 days, I want to see more green candles. So you see what that is, right? It was downtrending and now it's come up and it just had this big gap. That is the trade I want, because something else that showed up in the research was when the gap shows a trend change, those are the biggest, best moves in the research they did. And those were usually found by the stocks that were crossing the 10 period moving average. That's why they use that. But we'll have the 10 period moving average that I, at least that I could find in the filters here. So, so this is my approximation of it. And this is what came up instead here. We've got CLNE. Isn't that interesting? So CLNE, if you don't know, that's being driven by the Wall Street bets crowd. That's the kind of one of the latest stocks that showed up on everybody saying, hey, this could be a short squeeze. We could, and so that's why it's $7 here, and all of a sudden it's $13 there, and it's kind of moving up. So this is a nice stretch. It's got the gap barely, and it's got a green day, but it's just barely a green day. So this isn't the best trade in the world. I like it when you see a clear tall candle after the gap. Didn't have it, but you can see the stock screener is turning that up, and it's fun to me that it just happened to grab one of the new stocks being touted on Wall Street bets. So we got GB, MRCB, right? I mean, each of these. It's nice on Finviz because you have these rollovers that quickly pop up a chart, but on here you got to go and type them each in. GB. See, now that is not a clean gap. It's a gap from where it opened from where it closed to where it opened on Friday, but there's not sort of white space in between, right? MRCB, did I get the wrong one? And CRB. CRB. Okay, again, we don't have the clean gap. So what I would do is I would just be going down this list, putting them in and saying which one. Oh, look, here's TZA. So this is on Finviz. I don't get these ETFs, but it's kind of fun, especially when I see one of my favorite ETFs. TZA is one of my favorite because if I wanted to go short an index, in this case, it's the Russell 2000. If I wanted to short the Russell 2000, TZA is the ETF, my favorite ETF to do that with, because if the Russell 2000 drops 1%, TCA goes up 3%. So you get a really nice move. If the Russell just sort of drops over the course of a week or two, then this is really going to move nicely going up. So anyway, there's a good setup on TZA. Now, personally, I wouldn't take this trade. I'm not going to take this trade. Why? Because of what I was mentioning earlier. I feel like a lot of what's going on right now is being driven by dividend payouts and the inflation trade kind of coming off the rails. Because this chart right here, lumber liquidators, LL, compared with lumber futures, this green line, and wood and cut, they're both timber ETFs, and Home Depot, right? Lumber liquidators is on this strong downward trend. Lumber liquidators is a retail store that just sells, well, lumber. Guess why, right? Home Depot sells a whole lot of things, but it has absolutely been correlated with the price of lumber futures. Look at it. See, here's Home Depot, this sort of purple line. It's gone way up and it peaks and it's been coming down. Guess where it troughed and peaked? Same place as where lumber futures did. And what are lumber futures doing? Essentially crashing. Now, yeah, lumber futures, if I go way back, pre-COVID, right? I mean, it's still above where it was pre-COVID, before the big drop. As this, it tripled. Lumber futures tripled in price from the pandemic lows up to their highs. But see how far that has come back since then. Way back. Come way back. And there's it's finding the support right here where it was before. There's a really good chance it might come up a little and then drop some more. Why is this happening? Well, because supply is returning. Finally, lumber is getting out there, and the speculators are realizing, oh, this isn't going to demand shortages, et cetera. They're not going to continue forever. We got to get out of here. We got to get out of our trade. So speculators have come off, and supply has come in. And this, see, people were all thinking, oh, this is inflation. We're going to have crazy hyperinflation in the US going forward. Now, the Fed says, don't worry about it. Nothing to be here. Now, I think the Fed's overstating things. I think there is going to be serious inflation, serious compared to, 5%, not 3%, right? I mean, that's bad for U.S. and savers and so forth, but it's not dire. It's not Argentina 20% a year stuff, right? And I think the market got ahead of itself. It started pricing in as if the U.S. were going to have that kind of inflation. It's not. And so now people are moving their money out, which is why you see this going on. Okay, real quick here. We're almost there. 10 minutes to the market open, and look what's happened. Aussie yen didn't follow the Nasdaq down. In fact, turned around, made a new high just in the last 15 minutes. At the same time, the Nasdaq is bouncing. These indications uh, tip the hat to me to say we are likely to open and drift a little higher in the U.S. markets. That's my guess. That's what I would expect to play out. That being said, I was about to show you. Oh, yeah, what's happening with gold? All right, so let's have a look at gold. GLD. I'm going to go back to the daily look. See, gold exhaustion gap, follow on, right? Back to the inflation theme. See, this is inflation. This is people worried about inflation. This is people thinking, we got to not speculate on inflation so much. And how it goes, right? So dollar, US dollar, DXY, you're a currency trader, you better not be trading against the dollar, I think. Well, today it looks like maybe that's a good idea. No? Sorry, that's 15-minute trade. I got to look at the day. There it is. Yeah. All right. So see what the dollar is doing? Boom, 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 boom. Yeah, it's coming back right now. So maybe, but yeah, I mean this is actually going to correspond with U.S. stocks bumping higher a little bit. But that whole move right there is that move right there. This is people thinking, oh, the dollar is not going to just devalue. We're not going to have runaway inflation. There's going to be some. It's not going to be runaway inflation, right? So anyway, we see evidence that the markets are pricing in a correction to overblown expectations of inflation. There will be some, but it just won't be that terrible. And so what does that mean? That means that there are still going to be buys out there. And so if you use this screener, you might be able to find where they are. Notice a lot of therapeutics, a lot of pharmaceutical trades, right? That's interesting. It basically means that the people are eagerly looking for big gains, and there's fewer and fewer places to find them. Meanwhile, SMN, check this one out. SMN. You know what that is? That's short basic materials, not short gold. It's short, everything else: steel, aluminum, copper, dirt, whatever. Right. So this is not all by itself a really great trade, see, because it's really thin volume, but it does tell you that hey, basic materials are a short. So stocks that benefit from basic materials moves. How about Caterpillar? Look at that. Down, 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 down. Yeah, it's bouncing. Get ready for the next top and drop it down. Now, I don't have a whole lot of time to go through all these, but I will just tell you on TradingView, if you're a TradingView user, and if you're not, I recommend you do because TradingView is a great charting site. There's an indicator that we featured a couple of months ago here on this program. The inventor of it, Alex Cole, showed up and told us the go, no go charts indicator. It basically takes a bunch of other technical indicators and puts them all together. Alex is a professional technical analyst, and he tried to create an indicator that puts that professional technical analysis level in your back pocket, so to speak. And what he recommended was, here's the no-go signal, right? Which is bearish. And so Caterpillar dropped. What he recommends is wait until you see these purple candles throw a pink candle. After the no-go signal, this is what he likes to do. See, let me go back here. Here's the go signal. And what he said was, you get this go signal, and sometimes it just takes off, and by the time you see it, you're way into it, right? Wait until you see the lighter color ones appear, and then buy these. That way you're ready for the next run up, right? And then same thing on the downside. Wait until you see, there it is, the no-go signal. Wait till you see the sort of pink candles show up, and then you're ready for the next downward move. And so that's what I think we would be doing right now. You got this move coming down. You wait for it to come up a little bit. When you see a light pink candle, there's your sell short. If in fact you're the kind of person that likes to sell short, that's that's a great way to do it. All right. So oh yeah, basic materials came from here, SMN, right? But look at all the ideas that going through this list gives you. You have Caterpillar, you have John Deere, right? Same kind of setup. You've got uh, 3M stuff. Interestingly, 3M has dropped, but it doesn't have any of the dark purple candles yet. That's really interesting to me. Um, Big high volume move coming down, right on support. See, and I mean, just look at what this is going to be. This is going to be, this thing bounces back up wherever it makes its high and comes down. You've got basically a head and shoulders kind of pattern. You get in on that, it breaks and then keeps going. I mean, that could be tremendously good for short side. Okay, we got somebody from uh, outside of Zoom. Great. Gordon, what are your thoughts on copper? Yeah, great question. Okay, I'm going to go to JJC, which is the ETF that tracks copper prices. And over here, I'm going to go to um, FCX, which is Freeport McMoran. And or McMoran. So here's copper, right? Same thing. Copper has been caught up in the inflation trade. Big gap drop. But notice no green candles at all. Nothing but drop coming down. And that's also driving that basic materials move. So if you go short on these stocks, short copper, short basic materials, you're going to have a lot more chance. How could you go short copper? Well, JJC and most copper specific plays don't have a lot of a higher volume, but FCX does. FCX has a lot of volume. So if you wanted to short the copper market you should never do short long term, right? Short is a 1 to 2 week swing trade play, and FCX would be the one to do. Do you jump in right now? No, 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 absolutely not. Over the course of this coming week, wait for that bounce to come up, and then when it weakens again, go after it. I don't know exactly how that'll play out, but that is what I would be looking for. Um, Now, some people say, well, copper is, kind of the leading indication of the economy. Well, okay, first off, we're still post pandemic adjustment. Everything is kind of thrown off. All the normal indicators aren't quite working the same way. Second, the inflation trade was overdone, and now there's a huge correction for that. So that's part of what's going on. Do I think that this is, you know, signaling the drop of all other U.S. stocks and equities? I don't, because if it were, we should have seen the Nasdaq dropping very seriously. Now that might still come the next day or two, but as we saw on those futures, we're actually not selling. A couple of minutes, we'll see whether or not the market sells going right out of the gate. But my guess is that even if it sells, it'll rebound quickly, and it will actually end the day higher today than we close. I mean, it'll close higher than we open. So that would be my expectation. Um, Always wrong, always possible that I'm wrong, and I get a better idea by changing that. But um, regard talks in 40 minutes. ECB president, she is right now still, yeah. Um, yeah. So that is going to be interesting. Uh, Lagarde speaks in 40 minutes. Here's the euro daily chart, got the go no go trend. So the euro looks a lot like the Aussie yen and you know everything else. Euro's not straight up commodity driven, but it is commodity influenced, especially if you're looking at oil. But see, here's oil. I mean, you talk about inflation coming off. Why isn't oil doing the same? Right? That's interesting. It was because there's. Oh, sorry, that's not oil. That is not oil. That's here we go. Look at the U.S. oil. This is the crude market. There it is. So, but we don't see oil just collapsing in price like we see a lot of the other commodities. Um, that's because there's still a ton of demand for oil, even at its high price, and markets are reopening, and people are betting that in the U.S. and throughout the world, there's got a lot of air travel demand. I know I'm flying this summer in a couple of weeks. I'm gonna be vacationing, so we'll see how expectations play out about that. But yeah, I think copper and basic materials they're going to rebound a little bit and maybe make their next leg down after that. But I don't expect it to go really hard uh, all the way down. I think it's going to go down less than it already has, and then it'll find some support and head back up. That's I had to guess because everything else is lining up as a yeah, we'll sell off a little bit and then we'll come back up. So, all right, let's see then. We are over the 1 minute mark of the markets. Let's see how the NASDAQ is opening on a 15-minute basis. And we are selling on the NASDAQ. So, yeah, here's me saying, well, we're going to bounce. Don't ever get married to your predictions. Yeah, get married to somebody you can commit to. That's what. But okay, so there's the first little bit coming right out of the gate, and we are seeing selling. Okay, let's go over and look at the Aussie yen and see how the Aussie yen is tracking in the same time frame, 15 minutes. So we'll go there. Oh wow, there goes the Nasdaq, really selling kind of hard there. And Aussie yen is not following it down. Okay, so the Nasdaq is selling, breaking the low of previous day, Friday, which you know was kind of a tight range day. And is it going to bounce back up or not? Question we want to ask. A little bit of a bounce right here. We'll see if that continues. Aussie yen is just starting to sell a little bit. Yeah. Yeah. See, the fact that it isn't all the way down and coming down makes me think that I don't know where, but at some point that's going to turn around and hold support. Pretty big candle though for a 15-minute candle right out of the gate on a Monday morning like this. I'll give you that. That's more selling than I did expect to see already. All right. How about the Smith and Wesson trade? If that's the way the market is opening, what's our Smith and Wesson trade doing? It might be giving us a buy indication. Oh, I mean, look how good that was, right? This was one of those where you had to go ahead and jump and get it. As I mentioned, I bought this before the market closed. In fact, I put it right here also. Oh, wow, that was quite the jump in paper trading. And there it is, SWBI, so that I could literally track right now. And oh, see, that just went away. Why? Because it hit my profit target that I had set for it. And so that trade, boom, is out. I put it on Friday and in my account, I'll have to go check it after we're done here. And I've received the profit from that just that quick. That's the way I love for the trade to play out because it opens, it hits that high, boom, it's done. One day. Now I go find another one. Repeat process, right? That's the kind of trade I want. I want those to be quick. It's not because I couldn't hold it. And this thing could go much higher. It really could. But my style of trading here is to grab these quick ones and just consistently pile them on. And that can happen even if the market's going down. So anyway, hope you enjoyed this. We're going to be doing this more next week. I'm going to bring you 2 new trades next week, well, a long and a short, and give you a better understanding of this methodology of finding these stocks with these free websites. There are other places you could do, but hopefully you heard enough of the principles for how to make those trades and how to find those trades. Um, we will be talking about that next week and following on how, wow, look at that SWBI. See, pretty good trade, huh? Um, Someone says, yes, thank you, but a bit afraid to try the gap trade. Well, come back next week and we'll give you some more examples of that and boost your confidence in it because statistically it's a very good trade. And hey, we certainly were fortunate enough to see this call play out fantastically just within the first 5 minutes of the market opening. It doesn't always go that way, but interestingly enough, the best trades do. All right, everyone, until we do this again next week, take care and trade well.